In this video, we're going to discuss monetary policy. Monetary policy is when the government uses interest rates or the quantity of money to achieve macroeconomic objectives. So the monetary policy framework was set out with the establishment of the Federal Reserve Bank in 1913. The Federal Reserve Act of 1913 created the Federal Reserve Bank and the goals for the Open Market Committee. Essentially, the Open Market Committee and the Federal Reserve Bank were to maintain the long-term growth of the money supply and credit aggregates that are commensurate or proportional to the economy's long-run potential. And in the process, there's the Federal Reserve Bank is supposed to achieve important macroeconomic objectives to maximize employment, to keep prices stable, to avoid inflation, and to moderate long-term interest rates. So the Fed's goals for monetary policy are threefold: to stabilize prices. We don't want to have too much inflation or too much deflation. To maximize employment, to make sure that we're as close to full employment as possible, and to moderate long-term interest rates so they are smooth and predictable and can be the basis of good economic planning and contracts. And so the idea is that in the long run, these three goals are in harmony. They don't really conflict each other, although in the short run, they might conflict each other. But the most important goal for the Fed and monetary policy is price stability. If first and foremost, the Fed is trying to avoid inflation or deflation and keep prices relatively stable. Now, the Fed achieves its goals in monetary policy by keeping the quantity of money in line with potential GDP. And so this is the quantity theory of money in action, that the growth in the amount of money in the money supply is going to be proportional, or should be proportional, to the growth in real GDP. If we grow money supply by a greater amount than we grow potential GDP, then we're going to have inflation. And if we grow the money supply by a lesser amount than we grow potential GDP, then we'll have deflation. So the Fed tries to keep the growth of the quantity of money in line with the growth in potential GDP. So the number one goal of the Fed is to provide for stable prices. And in order to do that, the Fed looks at core inflation. Core inflation is the consumer price index minus the effects of fuel and food. So fuel and food are taken out of the CPI to get to the core inflation rate. And the idea is that the core inflation rate is less volatile, that food and fuel are more volatile than the other elements. And by taking them out, we get a more reliable estimate of inflation. So the Fed focuses on core inflation, which is the red line on the chart you see here, and not on the CPI. Now, on the one hand, this is maybe understandable. They're trying to remove things they think that might overstate inflation. But on the other hand, food and energy are products that everyone uses. Their lives are impacted by food and energy. By removing them, you're taking away some of the relevance of the price index. The core inflation rate doesn't include food and fuel, or changes to prices in food and fuel, and yet most citizens, most people, this is part of their market basket, and so they experience these price changes even if the core inflation does not. But the Fed focuses on core inflation, the CPI minus fuel and food. So when the Fed is trying to maximize employment, they estimate and look at the output gap. How far is real GDP from potential GDP? as a way of trying to understand the health of the overall economy. So if the output gap is negative, then unemployment is going to be more than full employment, and the Fed will try to intervene to minimize the output gap, to generate economic activity as a way of also generating employment and reducing unemployment. So the Federal Reserve Bank achieves a monetary policy through the Federal Open Market Committee, the FOMC. That's the group that makes the monetary policy decisions and takes the monetary policy actions. So this is the group that's led by the chairman of the Federal Reserve. In this case, it's Jerome Powell, the gentleman in the middle. So Congress does not play a role in monetary policy decisions. The Fed chairman will report to Congress twice a year, but the Congress doesn't get to determine what the monetary policy is or what the right amount of money is. Congress really doesn't play a role in this. Unlike fiscal policy. In fiscal policy, Congress is the one who's in charge of spending. So fiscal policy is spending. So Congress plays a direct role in that. They do not play a role in monetary policy. It's also true that the President of the United States does not play a direct role in monetary policy. They appoint the chairman of the Federal Reserve Board of Governors and the members of the Board of Governors, but once they're appointed, they don't really get to determine what the monetary policy is going to be. So the Fed, in this case, is an independent entity conducting monetary policy on behalf of the country, and without input or direction from the Congress or from the President. So the Fed has two main policy instruments when they're conducting monetary policy. The first one is the monetary base, the quantity of money that's in the system. And the second one is the federal funds rate. The federal funds rate is the rate that banks would charge each other for loans that they make overnight. So a bank that's short on reserves might borrow just on an overnight basis reserves from a bank that has excess reserves, and the rate that they charge between them is called the federal funds rate. This is going to be kind of the lowest rates that are in place because the banks are just doing it for a very short time and from one bank to another, and they're very creditworthy. So these are going to be some of the lowest rates that we see. So the in addition to the quantity of money, the Fed has the ability to set the target for the federal funds rate. They don't set the actual rate themselves. The banks are able to make that determination between themselves. They figure that out and negotiate it themselves. But the Fed sets the target, and the target and the actual rate wind up being very, very, very close to each other. Now, once the Fed sets the target, they have to then take other actions to try to get the actual rate to be in line with the target. So the Fed sets the target and then conducts open market operations to have the actual rate, federal funds rate, move to the target federal funds rate. But this, the main policy instrument that they have is this targeting of the federal funds rate. We sometimes call it the Fed setting the interest rate. And what they're really doing is setting the target for the federal funds rate, the rate that banks lend to each other, and then all the other rates wind up being determined by those rates. So when there's a recession going on, or the Fed wants to avoid recession, they'll lower this federal funds rate target, lower interest rates to increase the amount of money in the system and economic activity. And conversely, if inflation is above the rate that they want it to be, if it's too high, then they will raise interest rates. They'll raise the federal funds rate target as a way of decreasing economic activity and decreasing inflation. Now, when the Fed takes an action on interest rates, they normally only move the target interest rate 0.25% at a time, either up or down. And so if they wanted to move the rate 0.5% up, they wouldn't move it 0.5% up. They would move it up 0.25%, and then they'd wait another 6 weeks, and they move it up another 0.25%. So the way they get to a half is by two moves of 1/4 each. And the idea here is they want to be gradual. They want to be incremental, so they don't wind up disturbing the markets for money and for loans too much. So people have an ability to adjust over time. Now, they set the federal funds rate target, but they don't actually set the federal funds rate. That, as I mentioned before, is determined by the banks who are lending and borrowing from each other. So how does the Fed get the actual rate to equal the target? Well, they conduct open market operations to adjust the quantity of the monetary base, the amount of money in the system. And then if they do that right, then they can have the actual interest rate, the federal funds rate, move to be equal to the target. So this is a demand curve for reserves. The demand curve for banking reserves, it's downward sloping like all demand curves. The higher the federal funds rate or the price, the fewer are the amount of reserves demanded, and the lower the federal funds rate, the more reserves are demanded. And so, the federal funds rate, in a way, is an opportunity cost for holding reserves. If the federal funds rate is high, you're going to be less inclined to hold reserves because you're losing the ability to loan them out to somebody and make a higher rate. So there's a downward sloping demand curve for bank reserves. The federal funds rate is the price on the left column, and the quantity, of course, is how much reserves are demanded at each one of the prices. And again, in this case, the price is the federal funds rate. Now, there's also a supply of reserves, and this is the horizontal line here. There's a certain amount of money in the system, and there's a certain amount of reserves that are derived from that amount of money in the system. And at the point where the supply for reserves and the demand for reserves intersect each other, it tells us the quantity of reserves, and it also tells us the price, or the federal funds rate. So let's say they wanted to change if they wanted to change the rate, well, what they would do is they would change the target. Maybe they would lower it to 4, and then they would have to conduct open market operations to have more reserves supplied. So the new equilibrium point would be at a point where this intersection happens at 4 instead of happening at 5. And so that's how the Fed uses the quantity of money and open market operations to have the actual federal funds rate equal the target federal funds rate. So when they're doing monetary policy, they have 3 goals. They want to have stable prices, they want to maximize employment, and they want to make sure that the output for the economy is as close to potential GDP as possible. So they forecast the inflation rate, the unemployment rate, and the output gap. And so when they're worried about inflation, they want to know, is the inflation rate inside of the Fed's comfort zone? And by inflation rate, they are looking at the core inflation rate. And if the inflation rate is above their comfort zone, then they would raise the federal funds rate target. If the inflation rate was well below the comfort zone, or expected to move below it, they might consider lowering the federal funds rate. So they would lower the federal funds rate and hopefully create more economic activity without the worry of having inflation happen, because inflation is within or below their comfort zone. Now, they also look at unemployment. Is the unemployment rate above the natural unemployment rate? Do we have an employment level that's less than full employment? Well, if the unemployment rate is high, if the amount of employment is less than the full employment rate, well, the Fed would consider lowering the federal funds rate. And they would do that to try to have more money in the system, more economic activity, as a way of having more hiring and employment. And conversely, if unemployment if the employment rate is above the full employment rate, well, maybe there's too much pressure in the system. Maybe we have an overheated labor market with a labor shortage, and this might put pressure on wage rates and might feed inflation. So in this case, the Fed might raise the federal funds rate. If they're worried that the employment market is overheating, maybe they would they would raise the federal funds rate as a way of decreasing the amount of money in the system, decreasing the amount of economic activity that happens, and then, of course, there's less employment as a byproduct of that. And then they have to also look at the gross domestic product. Is real GDP above or below a potential GDP? They have to have some forecast of what the output gap is. If the real GDP is below potential GDP, well, then we have a recessionary gap. And the Fed would lower the federal funds rate to put more money in the system and increase economic activity. And as a result of that, you'll have a greater real GDP will rise and be closer to potential GDP. And when the output gap is positive, we have the opposite situation. We have an inflationary gap where real GDP is above potential GDP. Economy is overheating. We need to raise rates as a way of having less money in the system, less economic activity, and less pressure on prices, wage rates, and inflation. So that's kind of what the Fed does when they're doing monetary policy. They try to understand, is inflation in our comfort zone? Is employment close to full employment, and is the output gap negative? Do we have excess capacity in the system? Is real GDP not as much as potential GDP? And in cases where they want to increase the amount of economic activity, they will lower the federal funds rate target. They will increase the supply of money in the system. That increases economic activity, and then it increases production and employment. And in cases where they believe the economy is overheating, the inflation is too high, if the employment level is above full employment, well, then maybe we need to cool the economy down a little bit. We'll do that by raising rates. That takes money out of the system. By taking money out of the system, we have less economic activity, and then we have less employment and less output. And so that's how the Fed goes about monetary policy. We can see this process on a chart here. On the left is when the Fed wants to increase economic activity. They start that process by lowering the federal funds rate. They will buy securities in an open market operation. This will put reserves into more reserves into the system. With more reserves, the interest rates come down. The quantity of money in the system increases, and as a result of that, you'll have more consumption expenditure, more investment, and more net exports. Aggregate demand increases, and in the end of this process, you'll have more economic activity, more employment, and you'll have real GDP growth, and you may even have a rise in inflation, which you're not concerned about if it's still within your comfort zone. Now, one of the things and the process in green on the right is just the opposite, is when they want to contract the economy or reduce inflation, they raise the federal funds rate, and a similar process happens. Now, one of the things to notice about this is a long process with many steps, and you don't really have control over all these steps. You're just trying to affect things from a distance, and the result is this process takes a lot of time. It could take days or months or even longer, maybe a year or longer, to achieve monetary policy objectives. There's many, many steps here. This is not a simple process that the Fed has. They have to go through this process of setting target rates and then conducting open market operations, and then having the rest of the economy, work the intended consequences through. So this process is a very involved process, a very long process with many, many steps. And so the Fed controls the target federal funds rate, and that's the lever that they work with, the target, and they conduct open market operations to bring the actual federal funds rate in line with the target federal funds rate. But many of the interest rates that affect the economy are not the federal funds rate. They're rates that, the federal funds rate is rates that the banks use to loan between each other. But what about loans that the banks use to loan to businesses or consumers, or for the many loans that they make? Well, those loans often move very closely along with the federal funds rate, which is why the Fed targets the federal funds rate, because if they're able to do that effectively, then all the other interest rates that are in the system, the rates for mortgages, the rates for business loans, et cetera, will move in a similar direction. They're going to be higher than the federal funds rate, but they will move in a similar direction. And so when we look at monetary policy and the Fed changing the federal funds rate target, well, what gets impacted by that when this monetary policy process is enacted? Well, the answer is everything. Interest rates are determined by the federal funds rates. Exchange rates are determined by the strength of the dollar, and which is affected by the level of interest rates. All of the bank loans that are made between the banks and businesses, or the banks and citizens, the banks and mortgage holders, are all determined and work off the federal funds rate. And then the amount of consumption and aggregate demand, as it works its way through the system, are also influenced, and along with net export. So the answer is monetary policy affects really just every part of the economy. And if we go back and we look at, if the Fed wants to influence inflation, well, if they feel that inflation is maybe too low, well, they're going to lower rates. When they lower rates, there's going to be more money in the system, more loans rather. When the Fed lowers rates, they increase the amount of reserves. When there's more reserves, there's more loans. When there's more loans, there's more money, and when there's more money, there's higher prices. So if they want to affect, if they think inflation is too low, or maybe there's deflation, if they want to have inflation within the comfort zone and they have to have prices go up to do that, well, then they start out by lowering rates, conducting open market operations to put reserves into the banking system, and then the system takes over from there by having more loans, more money, and higher prices. And the opposite is true when inflation is too high. If it gets outside the comfort zone, right now, currently, the Fed's comfort zone is 0 to 2%. That's generally where the Fed tries to have inflation go up 0 to 2% in any given year. But let's say it's at 3 or 4%. Well, now it's beyond their comfort zone, and they need to raise rates, conduct open market operations that sell securities and to member banks. There's now less reserves in the system. When there's less reserves, there's less loans. When there's less loans, there's less money. And when there's less money in the system, you have a downward pressure on prices, and you'll have less inflation. So this is how the Fed conducts monetary policy to influence the macroeconomic goal of stable prices, of keeping inflation within the target zone. And again, monetary policy is based on the quantity theory of money. The quantity theory of money says that if you increase the quantity of money, the growth of the quantity of money, at the same rate that you increase the growth of potential GDP, well, then you're going to have no inflation. If you increase the growth of the quantity of money faster than the growth of potential GDP, well, then you will have inflation. If you increase it slower than the increase in potential GDP, you'll have deflation. So the quantity theory of money is at the core of monetary policy. You can say in a sense that our monetary policy is based on the quantity theory of money, because they use the quantity of money as the tool to conduct open market operations. And so again, the Fed, when they look at inflation, they want to keep inflation in the comfort zone between 0 and 2%. And in order to do so, they have to set a discount rate target and conduct open market operations. So the quantity the growth of the quantity of money equals the growth of potential GDP. That's what they're trying to do when they are trying to achieve stable prices, the most important monetary policy objective. Now, they're also worried about the output gap. That's the second monetary policy objective they have, which is to maximize output, maximize production, make sure that real GDP is as close as possible to potential GDP. And it's a similar type of situation. So they will, if they feel that the output gap, if the output gap is negative, if potential GDP is less, if real GDP is less than potential GDP, then they will lower the rates, looking at open market operations. So there's more reserves in the system. With more reserves, there's more loans being made, more consumption and investment happens when there's more loans being made, and then we have a higher GDP. It works the opposite when the economy is overheating. If the potential GDP, if real GDP is above potential GDP, well, that's not good either, and so they do the opposite. In that case, they will raise the target rates. They will they will sell securities to member banks as a way of reducing the amount of reserves that are in the system. When there's less reserves and higher rates, there's less consumption, there's less investment, and we have a lower GDP. And the idea here is we want GDP, the real GDP, to be in line with the potential GDP. When we have lower interest rates, well, that lowers the cost of spending. It lowers the opportunity cost. So we can have more expenditure. We can have more borrowing. We can have more investment and more exports. And all these things we know will increase in GDP. So if the Fed decides that they want to reduce the output gap and increase real GDP, so it's closer to potential GDP, they set the discount rate target commensurate with that, and then conduct open market operations to bring about having more reserves, more loans, more money in the system. That will result in a greater aggregate demand, more consumption, and more investment. And so real GDP can be as close as possible or equal potential GDP. So again, you can see there's many steps in the process of monetary policy and in terms of open market operations. We have to size up the situation. Are the macroeconomic objectives where we want them to be? If they're not, we have to then decide what to do with interest rates. We then have to conduct open market operations to get the actual rates to be closer to the target rates that we have. That adds reserves, and that changes the amount of reserves and loans in the system, which changes the amount of money in the system, which then will affect prices and output and employment. And so you can see that we mentioned before, the Fed focuses on the target federal funds rate, the rate that banks charge each other. But most of the rates that people see in the economy, unless you're a bank, are not the federal funds rate. They're mortgage rates or car loan rates or rates that you might use to borrow money from a bank to start or expand a business. And so these rates are determined in the market for loanable funds, which is affected by the federal funds rate, the rate that banks charge each other. So we can see here that when we talk about the federal funds rate, an interest rate is made up of many components. It's made up of the real interest rate, which represents the time value of money. And then during the time when the loan is outstanding, the borrowers needed to be compensated for any inflation that happens. So there's an inflation premium equal to the expected inflation rate. And this is what goes into the federal funds rate. It would be the real interest rate and any expected inflation that happens in the time that the loan is being made. But it doesn't include other things like time-specific risk. If you're going to borrow the money for a longer time, you're going to pay a higher rate than borrowing the money for a shorter time because there's less risk associated with a shorter-term loan than a longer-term loan. And then the loan-specific risk. Is the person that the money's being loaned to, do they have they have a good credit rating, a good history of paying things back? Does what they're borrowing the money for seem safe, and that type of thing? So the interest rates that we see are made up of all four of these aspects: the real interest rate, an inflation premium, a time risk premium, and then loan specific risk. And so in this example, we might see federal funds rate being the bottom two. This in this example would be 4%, but the rates that are in the market are 7%. And so this explains kind of why we see the difference between what the Fed says is their interest rate target and what the banks charge each other, and then the rates that we see in the marketplace. Now, they are related, as we mentioned. The rates we see in the marketplace are directly related to the federal funds rate. If the federal funds rate goes up by 20%, then the rates in the market in general are going to go up by 20%. It may not be exact because they are two separate markets with two separate sets of dynamics, but they're interrelated and directly dependent upon one another. So let's look again at how the Fed conducts monetary policy using our supply and demand chart. So the first thing, if the Fed wants to fight recession, if the potential GDP is below, if real GDP is below potential GDP, well, and as long as inflation is low and within the target range, well, then the Fed will lower the federal funds rate target. So they might lower it from 5 to 4, and then they conduct open market operations to purchase securities from member banks, putting more reserves on their books. So the quantity of reserves increases. And if you notice what happens here, they set the target rate to a lower number and then conduct open market operations to get the supply of money to equal the demand, the supply of reserves to be equal to the demand for reserves at that lower rate. And so the first thing is to set that target and then conduct the open market operations. The result of that, more reserves in the system, more loans is more money. There's more money in the system. Interest rates will fall. And this is true not only at the federal funds rate level, but really the supply of money increases the supply of loanable funds also. This is the money that you and I use to borrow to start a business or buy a home or lower a car. And interest rates fall in that market as well, the related markets. And so when you have lower interest rates, you can have you have an increase in aggregate planned expenditure. That's both consumption and investment when interest rates are lower. And so real GDP increases and hopefully gets to be equal to potential GDP. We can see a similar process when the Fed wants to fight inflation. Here, inflation is beyond their comfort zone. The comfort zone is 0 to 2%. The output gap is positive, meaning that real GDP is beyond potential GDP. And so the Federal Reserve will raise the federal funds rate target. So they raise it from 5 to 6. They conduct open market operations. They sell the securities to the member banks. That means there's less reserves in the system, so the quantity of reserves decreases. And we have a new equilibrium in the market for bank reserves at a higher federal funds rate price. The demand for reserves is equal to the supply of reserves after the open market operations at a point where the price, the federal funds rate, is equal to 6 rather than 5. So that's the way we get the actual rate to move closer to the target rate. Now, with a decrease, with less reserves in the system, there's less loans. With less loans, there's less money. And so the supply of money is lower. Now, short-term interest rates have to rise. And so this happens in also in the loanable funds market, the markets that we go to get loans to start businesses and buy houses and finance cars and things like that. And so the real interest rates rise there also. And eventually we have less money in the system. We have a lower supply of money and higher, we eventually we have higher interest rates. Because we have higher interest rates, we have less investment, less expenditure, and the real GDP decreases and becomes we close the inflationary gap, and the real GDP now again equals potential GDP, and the inflation rate is lower. So um, again, we talked. When we see this, lots and lots of steps here. They have to estimate the economic variables, the macroeconomic variables of unemployment and inflation and the output gap. They then have to determine what to do with the target rates, conduct open market operations, and then have the markets for loanable funds and all the different markets depend upon these things to have the dynamics work through the system. And this is a very a long process. We often talk about monetary policy being like a string. It seems to work better when we're trying to reduce economic activity than it does when we're trying to expand economic activity. Because when we put more money in the system, it's never, in different times, different things happen. Sometimes people will invest it to spend it. Other times they will save it, and you just don't know when you're trying to increase economic activity. It's more straightforward when you're trying to decrease economic activity using monetary policy than when you're trying to increase monetary policy, increase economic activity using monetary policy. And so we say that the monetary policy process has very loose links. The variables, there's a lot of lags in the system, and the response of the system is different each time. It doesn't respond, you might change a rate by a quarter point one time and get a certain response, and another time get a completely different response, because all the economic activity we're talking about, including all of the rates in the various markets, they're loosely linked to the federal funds rate. And they generally move in the same direction because they are interrelated, but it's not a direct relationship. So the result of this is, the monetary policy transmission process is very long and drawn out and doesn't always respond in the same way. Monetary policy is difficult. Now, there's been a proposal recently by the Fed. One of the things they want to do is remove the intermediaries, remove all these steps. Maybe, and what they've thought about doing and are discussing doing now is having accounts with individual consumers that will create a direct connection between the Fed and individuals without intermediaries. So if they wanted to increase aggregate expenditure, they could just deposit money directly from the Fed into the bank accounts of citizens and businesses and other economic actors without all of these steps in between. And the idea here is that, since monetary policy is difficult, since there's lots and lots of steps, it doesn't always work out the way, this might be a more effective way to do monetary policy. If we want more expenditure, we put more money in the system. And so this is just a proposal at this point, but there's been some support. Treasury Secretary Yellen, who was the Treasury Secretary, who was the former chairperson of the Fed, has signaled support for this, that she's supporting doing research into this digital dollar and direct relationship between the Fed and individual citizens and maybe the Treasury and individual citizens. So these are some of the ideas being discussed on maybe more direct ways to do monetary policy. Okay, now let's talk about the banking system. One of the things the Federal Reserve Bank does is oversee the entire banking system and making sure the member banks are following the laws that they have to follow. Now, sometimes a bank will fail. You might have 100 banks, and once in a while, maybe one of them might fail. They might have made some bad loans or not had enough capital, or there's lots of reasons, right? Banks are businesses, and all businesses are subject to fail. And so when a single bank fails, it's not that big of a deal because the Fed can kind of step in and maybe loan the money as the lender of last resort, or maybe bring a bigger bank in on friendly terms to help the two merge, and this way, the bank, the depositors at the bank will be whole, and the business will be whole, and it can go on. And so, this is one of the things that the Fed has to do, which is to monitor individual banks and then deal with bank failures. And again, bank failures, they're not common, but but they do happen, and the Fed has a way of dealing with those. But then the question comes: what happens when the whole system fails? You can't have too much risk, too much leverage in the system overall. And if it's highly interconnected, if they're all lending to each other and there's lots and lots of interconnectedness, well, that creates a system-wide risk. A fall in asset prices could set off a crisis. You can have a kind of a run on the whole system. And this is what happened in 2008 when we had the financial crisis in 2008. There was, in general, sometimes the system gets ahead of itself. In general, in the financial system, there was too much risk being taken on. There was not enough capital balanced against that risk, and this was across the whole system. Now, a fall in real estate prices kind of set off, which is a natural thing that might happen in one market. Prices go up, prices go down. We know about that from supply and demand. But a fall in real estate prices set off a collapse in the mortgage market, and banks, being the ones that held the mortgages, started recalling some loans, and some of the people that recalled the loans they didn't have capital, and it sets off a chain of events. And many financial institutions, many businesses, the financial side of many businesses weren't able to absorb this in the very compressed and short time frame in which it happened. And so there was widespread, financial institutions. There were some bank failures. There were some financial businesses that had to be dealt with, and there were some mergers that happened. And so, the Fed kind of stepped in. We call this an extraordinary monetary stimulus. This is the response the Fed had to the 2008 financial crisis. They lowered the federal funds rate to zero. So banks could borrow as much as they needed to from the Fed at zero. They conducted massive open market operations, $2.7 trillion they put into the member banks as additional reserves. And we know that whole process. When there's more reserves, there can be more loans, there can be more money in the system. And deposit insurance was doubled from $125,000 to $250,000, meaning if a bank fails, depositors in the bank would be insured up to $250,000. So most individual depositors didn't have to worry about that. And then the Fed bought almost $700 or $800 billion of troubled assets from banks. So banks had made some bad decisions, made some bad loans. In retrospect, it was obvious the Fed bought them from them and as a way of trying to shore up the banking system. So these actions provided the banks with more reserves. They had a better quality of deposits, and they were able to get rid of the risky or bad assets. Now, this took a long time to recover from. After 2008, the economy, it took 3-4 years of slow economic recovery. It took a little while for the employment picture to get back in place, for employment to increase, and for this to kind of work its way through the system. So one of the questions that came out during this time, the main tool the Fed has is the federal funds rate. And they lowered the federal funds rate to zero. So what other tools do they have once they get there? Can you lower it below zero? Now, ironically, there are some people at different times who said, yes, we can have a negative federal funds rate, meaning it costs money to have money in banks. Now, we all kind of know what will happen there. People won't keep their money in banks if they're losing money by keeping it there. But be that as it may, Chairman Bernanke at the time said that the monetary policy was reaching its limits. The main tool we have is the interest rate, and if interest rates are zero, we don't really have anything left that we can kind of do. And so what happens? Well, the economy slowly recovered. Rates went up a little bit, but not a lot. Remember, the federal government has this huge debt that they've been accumulating. The economy is somewhat fragile. It took a long time for the economy to come back after 2008, so the rates did go up a little bit. And then we had in 2020, the coronavirus pandemic. It had obviously there were medical aspects to this, but there were major economic aspects to this. Businesses were closed down. People were laid off. The GDP shrank by 35% in the first quarter. So what happened? Well, the Fed lowered the federal funds rate to zero again. They conducted massive open market operations to purchase corporate bonds and mortgage securities, in this case, $4 trillion, so even more than they did in 2008 in the financial crisis. And this is in addition to the $3.5 trillion stimulus package that Congress made. So the government spent $3.5 trillion on stimulus, fiscal policy, and another $4 trillion in monetary policy in the Federal Reserve Bank. And so the idea again was to provide the banks with more reserves, allowing them to make loans to businesses and help keep the businesses that were struggling going, and to try to increase the GDP, and which took such a big hit in the first quarter, down 34%. And so, we've in the last little more than a decade, we've had two major events the Fed had to step into. We call these extraordinary situations, and so the Fed has been very active in these situations. Now, we have to ask ourselves, is the Federal Reserve Bank too big? In 2021, the Fed has $7 trillion in assets. The Fed controls interest rates. They control the supply of money and monetary policy. They're a large owner of government debt, probably the largest owner. There's $10 trillion on their balance sheet of government treasury bills. They're a large owner of home mortgages, the Federal Reserve Bank, and now a large owner of corporate debt. And they've made a significant amount of loans to the central banks of other countries. So the Fed has gotten quite big. The Fed is also bearing a lot of risk. The Fed now owns 1/3 of all U.S. mortgages. Some of the extraordinary monetary policy actions that they took in the last two crises was to start buying some of these troubled assets, buying mortgages, not only troubled ones, but excess ones. And so the Fed now owns really 1/3 of all mortgages. If there was a crisis in the real estate market, the Fed would be the one bearing and dealing with that risk. In the last decade, the amount of money in circulation around the world has doubled. We've gone from about 40 trillion to 80 trillion dollars around the world. So again, this is not just the United States who's increasing the supply of money by their central banks and putting more and more money in the system. This is a global phenomenon, but we know we want to keep the growth of the supply of money in line with the growth of potential GDP, and we know the potential GDP did not double in 10 years. So this is problematic. And if they weren't busy enough, the Fed announced earlier this year that they were joining the NGFS. This is a group of central banks that are worried about climate change and trying to prepare the banking system for the effects of climate change. So the Fed is has a lot going on. It's a very, very big become a very, very big part of the economy, of the monetary system, and really everything that happens in the economy. Now, in 2021, um, the Fed kind of made a statement. This is Chairman Powell recently, and basically, Chairman Powell is saying, well, we see faster growth in the future and maybe even higher inflation beyond the comfort zone, maybe inflation beyond 2%. But despite that, the Federal Reserve is going to keep rates at near zero for the foreseeable future. And it mentioned specifically until 2024. So we have, normally the Fed wants to have low rates when we have um, low inflation or anemic growth. Then you want to keep lower rates. That's the monetary policy objective to help us achieve our macroeconomic goals. But here they're saying they're going to keep low rates even with faster growth and even with higher inflation. So I think they're in a difficult position in a way when you have rates that are very low, near zero. You've had them for a long time, and you've been maintaining monetary policy to keep them low. It becomes difficult to change that. And so this is happening, even though investors are starting to expect higher demands from government bonds. If you look today, the United States has a debt of $28 trillion. They use government securities as a way of making those loans, and about 16 trillion of the 28 trillion dollars is held by the Fed and other government agencies. 10 trillion by the Fed and 8 trillion by their other government agencies. 6 trillion of other government agencies, and 12 trillion in private banks. So the Fed is taking on a larger role of buying government securities from the Treasury Department. The Treasury Department needs to borrow more money. There's a certain amount of money that they can borrow from other governments or from the public, from pension funds and that kind of thing. But they need to borrow even more than that, and the Fed is the one who has been loaning them the incremental amount, and their balance sheet is increasing, and the amount of government debt that they're holding is also increasing. So these are interesting and challenging times for the Federal Reserve Bank for monetary policy.